You know, a couple of days ago when I did a show drawing similarities between auto financing and mortgage financing. Well, it turns out there's a whole bunch in common. And considering the recent spike in repossessions with cars, we should probably expect a similar spike in foreclosures with your houses. That is, of course, if the government doesn't just get the hell out of the way and let nature take its course, which is another show for another day. But there is one difference that I think lenders and realtors alike need to understand. In auto financing, what's generally deemed to be a riskier loan, a subprime loan, carries a lower average balance than a good credit borrower or a prime auto loan. That's because broke people finance hoopties and rich people finance Audis. No judgment here, but the numbers bear it out. See, that's not the case with NonQM mortgage loans, our new subprime mortgage loans. They actually have higher balances than their prime counterparts like your conventional FHA and VA. Now, why is that? Because riskier loans like car loans should carry lower balances, not the highest balances, while prime mortgage loans should, like cars, carry the highest balance. But that's not true at all. Why is that? Well, there's lots of reasons. First of all, you have to understand this. Non-QM loans are not subprime loans, period.
It's not a loan, sir.
To go a step further, non-QM loans are not even riskier loans. Frankly, in a lot of ways, they're less risky, more creative, but less risky. I'll give you an example. Who would you rather extend your money to? Would it be a person with a 645 credit score with less than 3% to put down, virtually no money in the bank, yet demonstrates the ability to repay? Or somebody with a 770 credit score, 20% to put down, stacks and racks of cash in the vault, who also show the ability to repay? Yeah, the latter. The non-QM borrower. I rest my case. It's non-QM all day long, people. Also, just take a look at DSCR loans if you haven't already. I'm surprised everyone doesn't know this. You first qualify the home, not the borrower, the home. You see, if an investment property with multi-units pencils, meaning the rents offset the mortgage payment, the house qualifies. Ability to repay reimagined in a non-QM filter is a beautiful thing to lenders and realtors right now. So now as a lender or a real estate agent, all you got to do is find the stinking investor. We just put the cart before the horse here. I mean, what you have to do at that point is like, hey, if you want your investment to pencil today, I've got the multiplex for you. Get the down payment, close the deal, and you walk with your check. Why wouldn't a realtor today hit up their multiple listing system and find all the multi-unit properties, figure rents versus a DSCR payment, and then find a smart loan officer who would be more than happy to provide to you and figure out what properties qualify under a DSCR loan? This one's easy. Qualify the property today. It's not risky, it's not rate averse, and it's not agency when it comes to the loan. So why are non-QM loan amounts higher? It's really this simple. Non-QM loans are for higher net worth, higher end borrowers that don't fit into the agency mold. They're generally not for your FHA borrowers. Self-employed folks, real estate investors, foreign nationals, even prime borrowers, contracted workers, alternate documentation borrowers, and people with money and assets. And they're killing it right now with non-QM deals. You see, subprime loans all have the ability to repay, just like your prime loans, and that's huge. So as a realtor, if you want a local lender to walk you through these absolutely fantastic products who will increase your knowledge, professionalism, and success, hit us up and we will set you up with somebody who's going to help you out. See, working the non-QM angle for a lender or realtor is kind of like corking your bat at the All-Star Home Run Derby. I mean, if you can get a competitive advantage, why wouldn't you? Oh, and one more thing in other news, and recently and oft discussed on our program, so don't say we didn't tell you so, Farmers Insurance just pulled out of the state of Florida, and in doing so affected over 100,000 policies, including your home insurance policies. Yeah, that's kind of big. Why would they do this? Well, courtesy of federal and state laws and policies, it doesn't pencil for insurance companies to write these policies anymore. Listen, guys, I'm telling you, this is big. Florida and California in particular are facing a housing crisis, and at this point it doesn't look like it has anything to do with inventory or rates. It's housing hazard policies and us not writing them anymore. See, because without those hazard policies, no loans get funded, and with no loans funded, our industry is stuck in the mud. So if you, my God, have any influence from your trade group, your trade association, you need to point your lobbying faculty in the direction of insurance and our policies, and we need an overhaul. That is, of course, my friends, if it's not already too late. Hey, I want to let you know that our partners over at Oaktree, our non-QM partners, that their production is trending north right now. How many mortgage companies can say that their production is trending north in this market? Well, what's the reason for it? It's very simple. They're really good at what they do. They're offering competitive rates, but they're filling a void. They're scratching an itch where other prime or agency loans simply aren't doing it. Non-QM is a beast right now. If you want to know more about this, as you should as a realtor lender, my God, they'll reach out to you today. Just put this arrow in your quiver, this tool in your toolbox. Just fill out the information down below. These guys will call you. No strings attached to it.